And fear in the markets and of the markets has led many money funds to stop lending to Europe and start raising cash. They're worried about investors rushing for the exits on bad news. TrimTabs keeps track of money flow, and its chief economist, Madeline Schnapp, is with McKee. Michael?
Thank you very much, Mark, and thank you for coming in off the lake to speak with us here. TrimTabs does keep track of money flow. We saw people getting out of the markets. Mark was just talking with Marvin Goodfriend about whether it was a real correction or a panic selling. You say the market was ready for a correction.
Well, our position for a long time now has been the economy is going to be stuck in a slow growth mode for a long period of time. It took 25 years of credit expansion to get into this mess, and it's going to take a long time to unwind it. We really see slow growth for, certainly through 2011, probably through 2012, and perhaps, depending on how quickly the housing market recovers, clear into 2016. So that's been our position for a long time, even against a lot of the market participants last year. So we haven't changed our position any. I think what happened yesterday was the market finally realized it was in an overbought position and is correcting somewhat. Now, depending on sentiment, if sentiment becomes extremely bearish, perhaps it'll continue from here, but that remains to be seen. The market is certainly unsettled right now, so to say the least.
Do you see, in terms of the money going in and out of the markets, that there is a bearish feel? Retail investors never really got back into the market the way they were in before 2008.
No, and I think that's a demographic issue. You have baby boomers becoming older now and nearing retirement, and they're needing to really begin to think about and get ready for their retirement, and suddenly woke up and realized, hey, we just went through a severe market correction in 2000, and we need to be much more careful about our assets going forward to make sure we're not living under a bridge somewhere. So I think there's been, and those things sort of are generational, and they end actuarially when the baby boomer generation sort of disappears. So unfortunately, I think we're going to be stuck with individual investors that are older, say, than 50, not materially participating as much as they used to.
So that's not good overall for the markets or for the economy. What have you seen in terms of what people are doing with their money these days? Are they saving more? Younger people not going into stocks but saving more money, or are they staying in cash?
Well, the savings rate, has been increasing, and that's because people are becoming much more cautious about their money, and so many of consumers now are deleveraging, trying to pay off debt. 25% of homeowners are underwater. They need to be able to sort of somehow get their feet back on the ground. So there's just been a sea change in terms of how people handle money from the go-go days of 2002 onward, 2007. I think you're just seeing a whole different generational attitude about money, and people realizing what is money. Money is a store of your wealth, and there's certain areas that are a little bit safer to store your wealth than perhaps risk assets. So you're seeing just a different sort of participation. My particular expertise is in macroeconomics, and so we track job growth very closely, but using an unusual method. Our model is based on individual income tax withholdings to the U.S. Treasury. So we have a daily measure of what's happening with wages and salaries and job growth. And our job growth numbers are quite a bit stronger than our model said. Job growth was 160,000 this past month. Last month, our job growth model said there was 128,000 jobs, and the BLS is considerably lower.
So maybe we'll see some more upward revisions. Madeline Schnapp, thank you very much
very welcome
for joining us today. We'll let you get back out on the lake and see if you can catch some more
I love
fish.
fishing.